There are three main opportunities with strategies. I think first and foremost is to hedge against the risks of rising interest rates. We can do that directly through interest rate swaps as well as through some of the currency markets. And that really proved critical in October 2018 when interest rates rose, caused losses in not only bond funds but a lot of risk assets, and we were able to generate a positive return. I think that is an environment we expect to continue, and therefore we still have positions in the fund to take advantage of higher interest rates. The second would be a hedge on populism. We think that populism divided countries, divided governments, weakening institutions is leading to a lot of dangerous economic policies. And Europe is probably most underappreciated in this realm, so our short euro position is a hedge against broad populism most prevalent in Europe. The third would be some select opportunities in South America. We see good policies being implemented in places like Argentina and Brazil. Argentina is one of the few countries in the world that had passed a bipartisan budget that will target a fiscal surplus. Not present in most countries with populism. The second would be in Brazil. They're undertaking massive pension reform. Again, not a reform that we see really doable in most countries throughout the world. So there are some opportunities for orthodox policies. And there are a couple major headwinds. The first would be populism. Divided countries, divided governments, leading to huge deficits, inward-looking thinking, rejection of globalization. This can be sort of manifested in trade wars, it can be manifested in anti-immigration policies. All of these tend to not do well for financial markets. I think that's one of the headwinds. The second, primarily in the US, but also in a lot of countries, massive ramp up in government spending and deficits. And again, not good for bond markets, hence the reason we have negative interest rate exposure. The third concern we would have would be underappreciated inflation. There's been talk of a US recession, US deflation for a long time, and the reality is tight labor markets, decent US growth, we actually have the reverse. We have rising inflation. I don't think that is being appreciated as a risk, and in fact, that will have some adverse effects on people who don't get ready for that.
The value of investments and the income paid out can fluctuate. Investors may not get back the full amount that was invested. Potential investors should read the details of the prospectus and product highlight sheet before deciding whether to invest in the fund.